Hello and welcome to the look ahead for Friday, the 7th of March with me, Fiona Cincotta, Senior Market Analyst at City Index. So overnight, we'll be watching out for trade data from China. In the European session, we have GDP figures. In the US non-farm payroll will be closely watched. And we also have Canadian jobs data as well. But just kicking off with the US non-farm payroll, expectations are for 160,000 jobs to be added. That's up from 143,000 last month. Also expecting to see unemployment remain unchanged at 4.1% and wage growth to stay at 0.3%. Now, the lead indicators, if we think about what we've seen sort of coming into this reading, we've had mixed jobs data across this week. And on the one hand, we saw ADP payrolls were considerably weaker than expected at 77,000. On the other, we saw the employment subcomponent of the services PMI increase. We've also seen a massive increase in challenger job cuts. Now, that's a result of the job cuts that are being made across the federal divisions by Elon Musk. Job cuts were up by 245%, so around 100. I think it was 171,000 job cuts. Of those, 62,000 belonged to federal positions, so federal job cuts, just to get an idea of the stage of what's happening. Now, I guess we're going to start to see those figures come through in the US non-farm payrolls a little bit potentially this month in the February reading, but then considerably more would be expected in the March reading. Now, the data also comes as we're sort of seeing growing concerns over the outlook for the US economy in line with the ramping up of trade tariffs from Trump, 25% against Canada, Mexico, and also 20% against China. But we've also seen the latest developments. He's rolled back those tariffs on automakers, giving them a month extra to sort out supply chains. And that, whilst it's helped US automakers recover higher, we have actually seen a continued decline in the dollar and broadly in the S&P 500 as the uncertainty about all this sort of toing and froing with trade tariffs is making it very difficult for corporate America to plan anything. Now, those concerns over a potential slowdown in the economy in the US is really weighing on the US dollar. The Federal Reserve also expected to be cutting rates on more occasions this year than was initially expected. So here we're looking at US dollar, Japanese yen. We can see that it's trading down at the 147.60 level. That's the lowest it's traded since October last year. So we're looking at a 6-month low as it's trended really quite consistently lower from that 158.90 high that we saw at the start of the year. Taken out several key support levels. We've taken out this one here at the 148.70. That was the low that we saw in December. Heading towards 145. That's going to be the next level to be watching out for on the downside. We are actually just testing now this lower band of the falling channel. So be interesting to see whether we see a slight recovery from here or whether we see a breakdown of that level. RSI supports further losses whilst it's out of oversold territory. So that's going to be the levels to be watching out for. Obviously, if we get weaker than expected jobs data, we could potentially see the US dollar falling lower, which could mean that we see further losses in the USD Japanese yen pair. So just whilst we're talking about the US, let's just have a look at what's going on in the stocks in the US. Here we go. This is the Dow Jones. We've seen, interestingly, once again, it's managed to find support here on the this support zone, which sort of runs from around the 42,350 level down to the 42,000 level, which is also where the 200 SMA is. Also, we can see just on these across this week, every attempt at those at that support level, we see that longer lower wick, which suggests there isn't as much selling demand at those lower levels, which could mean that the sell-off is steadying out, at least for now. But I think if we do get weaker data fueling any worries over the health of the US economy, then we could find that we test that support level and support zone once again. On the upside, levels to be watching out for 43,350. That's the high that we saw just at the end of December last year. And above there, we've got the 50 SMA and the 100 SMA around the 43,700 level. Now, just going to take a quick look at the euro US dollar. Obviously, we've had the ECB, look at that, ECB interest rate decision today, and we've got GDP data tomorrow. GDP data is expected to confirm the growth that we saw in the previous quarter. And this is the euro US dollar. I mean, basically, we've seen this absolute rally in the euro, and this is basically on the back of the expectations of Germany coming together and announcing a move to increase spending. They're sort of having a massive fiscal U-turn in this sort of coalition government, which is in the process of being formed. And it's quite interesting because I think, you know, there was expectations that this coalition government wasn't really, although it still hasn't properly been formed yet, but it wouldn't be able to achieve too much. And already they're showing that they're actually looking to rejig things quite considerably. Now, the euro has also pushed higher because we've had the ECB rate decision cut by 25 basis points. That was priced in. We already knew about that. However, the ECB are adopting, I'd say, a more cautious approach to further rate cuts, given the uncertainty surrounding the potential trade war with the US, and also given this expected increase in spending in Germany on defense and infrastructure, which could eventually be inflationary. So as far as this chart is concerned, we can see it's risen above the euro is broken out of this 105 level, which it tested quite frequently over the past month or so. Breaking out, taking out the 200 SMA, risen above 108. The RSI is overbought, so we could see some consolidation, even a move lower before any attempts towards the 109.30 and 110. Basically, as far as sort of levels to be watching on the downside, as I said, support there at 107.30, 200 SMA. Below that, you've got the 106 level, which is the level that we saw offering resistance on numerous occasions back at the end of last year. And then below that, the 105. It's not really unless we get below these levels that we're negating that near-term run up. So, you know, consolidation could be on the card, but as I said, the outlook is still fairly encouraging as far as the euro is concerned against the US dollar. Just finally, we're going to take a quick look at gold, because interestingly, despite all this uncertainty that we're seeing, we're not really seeing gold play ball. It's not hitting fresh all-time highs, as one might expect, given the uncertainty surrounding Trump's moves with trade tariffs, geopolitical uncertainty, and the fact that we've seen the weak dollar. But still, we're seeing gold really just consolidate after reaching that all-time high earlier in, at the back end of February. The price is holding above this support here, which is the 28.80 level. I mean, it would take a move below the 28.30 to create a lower low. So I think whilst we're seeing this consolidation between the uptrend, the upside at 29.30, that's 29.50 all-time highs, there is potential for further gains, I think, given the fundamental backdrop. That would be the level you need to be watching out for 29.55 for a break to the upside. On the downside, if you can see a break below 28.80, that could open the door to 28.50, but we'd actually need a break below 28.35.30 for a structural change and a lower low. So I hope that you've liked everything that you've seen today. And if you have, then please do give this video a like. Otherwise, I'll see you tomorrow.